In this week's update, how to profit in 2024 and beyond, the psychology of trading through volatility, and what we can learn from earnings season. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. All right, let's have a look at August in arrears and to a degree July as well, because it's been a pretty volatile period. So August in the US, we started with a big plunge. On August 5 was a combination of fears about a recession and growth. And then on top of that and related to it was the partial unwinding of the yen carry trade that seems to have been forgotten very, very quickly. And it just goes to show how leveraged global financial markets are, that the proverbial butterfly fluttering its wings in one part of the world causes an enormous tsunami in another part of the world. It's really, really quite extraordinary. But then following that plunge in early August, we had a big rebound. It was almost straight back up like it had never happened to finish in the positive for the month. So quite impressive in the US at the S&P level. The inflation data, retail sales data, that all calmed recession fears. People realised that what we saw in early August was just a single data point and that you need more than that to react. And then, of course, that meant that the Fed was motivated more to talk about interest rates being cut. And that appears to be an absolute certainty now in September. The only debate really is about the size of the cut. Will it be 25 basis points or will it be 50 basis points? The other key thing during the month too, towards the end, was the very eagerly awaited NVIDIA result. I can't remember any result from a single company being as important to market sentiment as this one was, or that's the way it's set up. And NVIDIA achieved another extraordinary result of growth. The quarterly revenues doubled, so the numbers were quite something. But expectations were so high that the outlook disappointed, even though the outlook was for further growth. The market has become very accustomed to just simply extraordinary results from NVIDIA and didn't quite get them this time. And I guess there's a bit of a hint in the NVIDIA results that points to the fact that the AI frenzy might just have to slow down a little bit, and that the rate of ascent is, it's not going to change, but it's going to slow down. It's not going to go into the negative, but it might just have to slow down a little bit because the returns on these incredibly massive investments, tens of billions of dollars, is not really coming through yet as far as, the market is comfortable with. So we'll watch this space. We'll have to see on that one. So the market reaction in the end on NVIDIA was a bit of a whimper, really. It was down 6-7% on the first session, but steady very quickly. There was really not much follow through in selling. So that was August in arrears in the US. And I suspect with NVIDIA that it's not yet, but I suspect there's a very good contrarian opportunity building, because sentiment is suddenly, or the narrative has suddenly shifted from, what an extraordinary company, to now, okay, maybe it's overvalued. So I think there is no rush to get into NVIDIA. And I actually hope that there's a bit more of a sell-off, because it will set up one of the decade's great trades if NVIDIA does experience a sell-off, because the AI revolution is not going away. There might be a bit of a lull in the investment frenzy, but it's certainly not going away. All right, so the journey so far in 2024, if we just step back and have a look at what's happened in the last 8 months, and regular viewers will know that what I present in these videos, it's the same message over and over again, reinforcement, because that's what we all need. We continually need to have our perspective refreshed. Now, at the start of 2024, the setup for the year really did look very enticing for a whole bunch of reasons I've talked about since January. And it's been highly productive if you had a good plan and you executed well. And certainly we've done very well in the Insiders Club. But stock selection and process, how you get in, how you get out, how you manage weightings, all those sort of things were always the absolute keys to a successful outcome. And I made that very clear at the start of the year. This was never a year about just buying anything and riding the wave. It was always about very specific stock selection and the process to manage, because there's been plenty of volatility. So one of the great challenges of 2024, and I guess most years, is the challenge to stay on board the really great growth stocks, because even the best of the best will go through 20% to 30% drops. That's normal, and it happens to everybody and every stock. So if you want to allow the great wealth compounders, the Apples and the Microsofts and the CSLs and the ilk of that stock, if you want to be able to get the really fantastic payoffs over a decade or 2 decades, then the challenge is, how do you stay on board when the price goes down 30%? And I've spoken about this on a number of occasions. The price of Apple in the last 2 decades, while having gone up, I don't know, 20, 30, 40-fold, I forget the number now, but it's gone through at least 4 corrections of between 30% and 50%. Yet the long-term return has just been sensational. It has been life-changing. So that's the challenge. How do you stay on board, not necessarily completely, but how do you retain exposure and manage your weightings to come in and out of those sort of stocks partially that will suit your psychology to allow you access to those fabulous long-term returns? If you get out of these stocks completely because you're feeling that you might be uncomfortable by the drop for whatever reason, then I guess that's just loss of perspective on the big picture of what you're trying to do as an investor, trying to micromanage it. But if you get out because you feel temporarily uncomfortable, then what is your trigger to re-entry? You've really got to know what it looks like, because inevitably, when you get out of a stock that's just gone backwards, you need that much more validation to get back in. You're more cautious. And so almost always you will end up paying a higher price to get back in than what you sold at, which is kind of nonsense, really. That's the classic buy high, sell low kind of situation. So you need to be very clear about what your re-entry trigger is going to be. So let's just, before I move on to the next slide, let's just go and look at some charts. I just want to pose some questions here. So the journey over the last couple of months. So we're really looking at this period. So that's the period that we're looking at over the last 2 months from the start of July. And it's been pretty testing, and you can see by the movement just in the S&P, and this is just the index. Imagine what it looks like on an individual stock level. It's far greater. It's been pretty testing. And the perspective that I want everyone to think about is that the index is not what you own, so that looks volatile enough. But individual stocks move far, far more in both directions. We had some very good ones and some not so good ones during earnings season. Now, if we look at July 1 to July 16, so that's from here to the peak, then it was pretty much straight up on the index, and trading was pretty easy. And what happens during that period is that we sort of get lulled into a false sense of security. And then from July 17 to August 5, we started to get a correction, pulled us back to the blue 50-day moving average line. And then, bingo, August 5 came along with that jobs number and then the yen carry trade consequences. And the market just fell apart. Huge plunge, 2 big gaps. But then from August 6 onwards was a very robust rebound to actually end the month higher. So heaps and heaps of volatility. Now, we held firm and we profited during that period of time. Definitely that the Insiders Club portfolios moved higher and some of the stocks moved very significantly higher. And why were we able to do that? Well, it's just about clarity of purpose and process, and particularly on the exit triggers. There's 3 very clearly defined exit triggers that I use, and there's no debate, they're either ticked or they're not. And in almost all cases, there were a few exceptions, and we did take a couple of losses because it was warranted. But unless the boxes get ticked, then we stay on board, and we profited nicely as a consequence of that. So, in the spirit of trying to be helpful here, which is what these Sunday videos are about, what did you do? Just reflect on your period, because if you can't learn from the last couple of months of very valuable experience, then you're just going to keep repeating the same thing over and over. So what did you do? What emotions did you experience during that period? And if you said you didn't experience any emotions, then I don't believe you, because everyone did. I certainly did. But it's how you manage those emotions that's the key. Did you trade the news? Did you get all bother because of the news that was being sensationally and breathlessly reported? You really got to not do that. If you do that, you're almost certainly going to lose money. What could you have done better? So an opportunity to reflect and think about what you could have done better. Did you sell some of your best winners? Did you cut the tops off the flowers and leave the weeds, only to see your winners now trading higher than what they were? And now you have a real dilemma. Do you now pay more than you exited for to get back into the stock that you intended holding for the next 5 or 10 years? Did you hang on to most of your dogs, the ones that are underwater, unwilling to take a loss? And, as I say to members all the time, that when you're in a loss situation, as long as there's a valid reason for that stock price to go down, occasionally some good stocks prices go down, and you just got to wait it out and they rebound. And knowing the difference between a stock that is highly likely to rebound because the fundamentals are good and those that are not is a skill in itself. But if you've got a loser, then the value of that parcel of money is now worth what it's worth. It's worth less. So the question is not, do I want to take a loss? The question is, how can I grow the value of that parcel of money back to where it was when I started and beyond? Is it in this stock, which is going down, or is it in some other stock that's going up with great fundamentals? And the answer is bleedingly obvious. And yet a lot of people resist taking losers because they don't like it. Well, get over it, is my message. You want to constantly be making sure that your money is exposed to the best fundamentals and the best trends. That's it, pure and simple. Whether you get out of a stock for a profit or a loss is really immaterial. It's not looking at the process of investment the right way. So if you want to get better results, you've got to start thinking differently about the market. And if you don't change your approach, then you're just going to repeat what you've always got. So trading is quite simple. When you write down a trading plan, it should be a very simple document. And simple works. Complex doesn't work. Simple works really well, but it's not easy. And it's not easy because of what runs around in our head when we get tested. And July and August up here certainly test us. That's for sure. For most people, you need to find a mentor, because doing this on your own is unlikely to work out too well, because you've just got this battle in your head with emotional baggage, previous experiences, preconceived ideas, all those sort of things. Anyway, enough of that, but it is just so critically important. The ongoing journey from here, your decisions have just got to be guided by a plan. Just a series of, gut feel, buys and sells is not going to cut it. And as I said earlier, just think about how well that you have executed in the last 2 months, the last 2 years, and do you want to get a better result? Do you willingly embrace the opportunities that volatility creates when really good stocks get sold off sharply? August 5 was a godsend because it gave us entry opportunities if you were prepared to pull the trigger quickly that we've been starved of. Now, markets are more reactive now to news than ever, and that's because of the leverage. And if you follow the news, you are almost certainly going to lose money. You're almost certainly not going to make money. And that's just the reality, because most of the time the news is baked in before it lands on the desk. And that's what these Sunday videos are meant to do. They're meant to be, unbiased. I don't have ties to anybody or anything. They're meant to be balanced, to tell you exactly how it is that I see things, and to continually refresh your perspective, to just get you through from week to week. So that's what this Sunday video is all about. Turning to American stocks now, the S&P ended up 0.2% across the week. The NASDAQ gave up some ground as the rotation from big tech to smaller caps continues. The RSP was up nearly 1%, which is good. We'll look at that in a minute. And the Russell was pretty much break even, down just a fraction. So at the end of the day, it was a volatile week that really went nowhere. And a lot of that volatility is just centered around NVIDIA. The US dollar index managed to edge a bit higher, which is a surprise considering all the talk about rate cuts. 10-year yield up a fraction from 3.8 to 3.9, and the VIX did edge lower. So let's look at some other charts now. The RSP, equal weight, and this rotation out of big tech into smaller stocks. It's really on in earnest, and you can see that that chart looks so much better than the NASDAQ does at this point in time. And IWM, a little bit of a pause, but look at the individual stock level. There were some terrific responses to very solid earnings, and 20%, 25%, 30% gains in a session were in abundance. But equally, 20 and 30% smashings in a session were in abundance as well. So you really needed to be on the right side of the ledger with respect to that. All right, let's go through some of the other key things. Semiconductors, we definitely got a big sell-off that culminated on August 5. We've had a bit of a rebound, but not as robust as other parts of the market. And it's really just a bit of a thinking period at the moment for semiconductors as the uncertainty around AI sort of filters through. Looked at on a sector basis in the US, staples did well, top of the tree over the last month. Then healthcare, finance had a very good week. You can see, in fact, it's had a very good month. It's moved up very, very strongly. And then followed by materials, and then we get down to all of the more aggressive sectors of the market. Communication services, technology, consumer discretionary, and energy bringing up the rear. But what you'll notice, of course, is from the early month lows, the pretty good rebound. Now, if we look in Australia, the rebound in the information technology space, thanks to a large degree by WiseTech Global and Life360, did extremely well. But the banks here, despite the appalling valuation, in my view, well above the normal historic highs in terms of valuation, banks are still in favour. Don't understand it, but that's how it is. And then we've got materials and energy bringing up the rear. So that's how the market's set up on a sector basis. Just to summarise, the Aussie dollar bounced up pretty hard, 67.1. The ASX 200 was up just under 1% across the week. We saw a small gain for energy at the end of the week, but the trend is strongly down for the energy sector. And energy is a very sorry story in Australia of successive government failures over decades. The banks, the valuations I've talked about, they continue to be supported. Don't know why, but the IT trend is very strongly higher. The materials, of course, looking shaky. The iron ore price is contributing to that. Also, the lithium price and copper is not too clever either. All right, turning to precious metals now. Gold was down by $6 but we're still holding above 25.03. So the upward trend is still good. In Aussie dollars, 3,700 is where we landed. Silver eased a little bit towards the end, just under $29. If we look at precious metals locally, the sector is trending up. It's certainly looking better, and there's some very, very good results. But globally, it's a serious struggle. To be honest, if you look at GDXJ or GDX globally, it's not too pretty. We'll just get the gold chart on a daily basis. So you can see we're just forming up a little shelf here within an overall uptrend. And if we put that on a weekly chart, you can see that the uptrend really is very strong on a weekly. These lows here are going back to 2 years ago, September 2022. We've moved from 1,600 to 2,500, which makes it a very strongly performing commodity. It just seems to have snuck up on us. It hasn't ever really done anything terribly dramatic, hasn't really hit the news headlines as it has in previous decades, but the trend is very strong. And if we look at silver not performing as well as gold, which is a surprise to a lot of people given the added demands for silver with solar panels and some other industrial applications as well, and being a much smaller market. I think it's inevitable that silver has a great run, but I really have no idea when that might be. It just feels a bit like uranium. Uranium was a fantastic story, but it took 3 years to get there before the price finally took off. And I think everyone in the end got bored with it. I suspect silver may just do something similar. Okay, let's move on now to other commodities. Copper slipped a little bit back to 415. Nickel was pretty steady. Now the copper forecasts, copper really is a bit of a head scratcher. They've turned negative since a very buoyant start to 2024. You might recall copper went up to above $5 at a pretty fast rate and then immediately turned around and fell back again. And it's been a combination of weaker demand, a sentiment shift for investors and speculators, definitely. And what's happening at the moment is with some of the major broking houses that their 5-year forecasts aren't for copper not to get a heck of a lot better. If we wind back a year, everyone was sort of nodding and agreeing, and including the likes of BHP, who know what they're talking about when it comes to copper, was saying, look, 2026 will be moving into deficit and the price will have to start to move a lot higher. We're now starting to get forecasts that are saying, well, maybe to 2030 before we start to get back into a balanced situation. So how things have changed. Personally, they don't make sense to me. If decarbonisation is going to have any legs at all, then these forecasts don't make any sense when you look at supply and demand. But for now, it's a very, very negative sentiment. However, putting the contrarian hat on, of course, you should be perhaps looking for opportunities or be alert to opportunities. But I would suggest that you require validation. I would not be buying into copper unless the price chart is telling you a pretty good story. All right, crude oil was a little lower, 73.55. So we've been slipping since late April, early May. So wrapping things up, gaining clarity is absolutely everything. And not many people really get to that point where they're clear about what they're doing. It's just all a jumble of emotions, knee-jerk reactions, and grabbing at straws here, there, and everywhere. Gaining clarity and having process is absolutely everything, because that gives you the process to help avoid making emotional decisions. You need to know what your entry and exit triggers look like. I talk to members about style. What is the style of stock? And everybody to a degree is different. So what is your style of stock? And by that I mean large cap, small cap, which then feeds into the level of volatility. Do you want stocks that are going to have lower volatility, that are already profitable, that pay a dividend? Whatever it may be, it is actually quite easy to sit down and think about what your style of stock is, and therefore what the composition of your portfolio would ideally look like. And if you can do that, then you have set yourself enormously forward on the wealth creation journey, because virtually no one takes the trouble to do that. So think about the sort of style of stock that really suits your psychology and your investment goals. And then you also need to think about how you're going to play the inevitable corrections that we get in everything, and most importantly, the ones that you really want to stay with, the great wealth compounders that have been delivering 30, 40, 50% per annum over long periods of time. They're out there. Now, as they mature, that rate of return to investors does tend to slow down. Stocks like CSL are no longer capable of generating 30, 40% per annum returns over a period of 5 years. But in the earlier days, they certainly were. And there are plenty of stocks now that are doing the same thing. These are the emerging CSLs, if you like, in various areas. So how will you personally play those inevitable corrections that are going to happen? Better to think about it in advance than, try to make an emotionally charged decision at the time. So some really important food for thought. Portfolio analysts last week, we looked at, obviously, how to play the volatility around earnings. We looked at an ETF for those wanting some long-term exposure to the theme of AI, which is a pretty interesting ETF. And also I provided, Portfolio Analyst has been running since 2017 every week. I've been asked to analyse hundreds and hundreds of companies that had new technologies in all sorts of things, from medical science to industrial technologies to hot rocks to, whatever it may be. And hundreds of seemingly no-brainer new technologies. And I would have to say that at least 80% and probably closer to 90% never made it and went into long-term price decline. So always important to be able to go back and look and learn from what's happened in the past. Just to wrap it up, just a bit of a perspective on what we do. 3 services, the Insiders Club. It's very hands-on. It's the flagship service, has been running for a long, long time. It's for every level of experience, whether you're a beginner or whether you're a more experienced investor. And we've got plenty of those, and they just don't have the time to be as immersed in the market as I am, and they appreciate the perspective that I can bring to the table. So that's the Insiders Club. Then we've got Portfolio Analyst. You can do your own thing. You've got an analyst stroke fund manager as a sidekick. Use me as most benefits you. And then thirdly, we've got Portfolio Manager. If you want to be hands-off, you don't want to be involved in the day-to-day, but you want to retain control and you want to have visibility over your account, which is in your name. It's not pooled in a fund. It's in your account. You've got visibility. You control it, but we do all the work. So they're the services. That's what we do. More information on the website. There's my email address, and I'll be back with you next week as usual. Cheers.